We can talk to the head of research at Bank Julius Baer, Francine Gattiker, joins us from Zurich. Francine, thank you so much for joining us this morning. I mean, the banks are saying, guys, we don't need to be recapitalized. We'll shrink significantly. Are we still headed towards a credit crunch? This would be the worst case scenario for, frankly, the whole world.
Yes, indeed. I mean, this whole tune sounds quite familiar, and it's always been the case, ahead of major recapitalization exercises that we've seen these statements of banks. I mean, the last time we had that with Bank of America, and after that, exactly a few weeks after, they have to go to Warren Buffett for further capital. So I think this is really something which is at the core of the current situation to solve these issues, and I think to really make a difference there and really avoid a credit crunch, which would be the ultimate result if we really let them do this by themselves, so to speak, from a European politician's perspective. The ultimate thing would be to do really bold action and restructure a lot of these names, and not only restructuring, recapitalizing this, but also looking at the structure, meaning at some Landesbanks, do they still make sense? Do they have to go into wind down mode? I think we would have to really take a fresh look at the whole banking industry in Europe to resolve that.
So, Christian, at this point, I know it's difficult to actually put you on the spot on something like this, but is there a 50% chance that we are going to see a credit crunch? And, we had Morgan Stanley saying, for example, that the amount of shrinkage could be of around 2 trillion euros across Europe. This seems pretty unrealistic. And so will we see capital injections from the likes of France and possibly Italy? And what will that mean for the credit rating?
Well, indeed, I think the leeway or the room to maneuver for both of these countries, France and Italy, is rather limited in that concern. And therefore, of course, the hopes are so much focusing on the EFSF, this facility which could be leveraged. But then again, you have issues of a rating downgrade for these names, and France in particular, which would lose its AAA rating. So I think this situation is pretty much more complex than maybe the 2008 situation of the US, and for the time being, investors are treating that as a blueprint, the 2008 situation, and resolving that with TARP and so forth for the European side. But I think it's a lot more complex. It will take a lot more to resolve that and to avoid a credit crunch. And, we can guess, I think, if everything is left unchanged and there is no recapitalization, the probability of a credit crunch is a lot higher than 50%. But I think the incentives are pretty clear to do something about the situation. And we see that European politicians finally got quite decided on doing something about the situation. So I expect some news on that side.
But of course, Christian, you're talking about these politicians, and finally we're hoping possibly from some better news. But already today, if you look at newspapers or even our own Bloomberg exclusives, some are saying 2 trillion. Then some of the Germans are saying, no, absolutely not 2 trillion for this new EFSF bailout. It should be some kind of insurance, but only up to 1 trillion. Again, it's very confusing messages, and this is the last thing the market needs.
That's exactly my point here, and I think it's been a lot easier. It was a lot easier 3 years ago, where you had one country and with more leeways on the fiscal side. And at this stage, there's a conflict of interest, to be frank. I mean, on the one hand, you want to resolve these issues. On the other hand, you don't want to get the pressure off the countries that should actually stick to their austerity measures. So it is really a balancing act against that backdrop. And I think markets are very nervous, and a lot of investors have been caught on the wrong foot, and therefore we had this major short squeeze. But I think, the likelihood that this is going to disappoint, what we'll learn over the weekend, is rather high.
And so, Christian, very briefly, what kind of portfolio would you be saying people should have? Focusing on corporate bonds, or some actually earnings which came in better than expected?
Well, I think that's trading strategies to go for the earnings reports, and I think there's been a major move, so it's worthwhile playing for traders. For investors, I think you have to go where strength is, and strength is with non-financial corporates in mature markets, but also in emerging markets. And I think I would rather focus on a portfolio of these bonds, maybe not only quality bonds, but some sound corporate bonds that will give you some yield and also give you some upside in terms of an improvement on the situation.
Christian, thank you. Thank you again, Francine Gattiker, there, head of research at Bank Julius Baer.